I'm waiting for the real estate market to crash. I hear that statement all the time. Hey, my name's Jeff Tomlinson. I'm your Northern Utah real estate expert, and I want to spend a few moments with you to explain a little bit more about what the crash is. Number one reason people are telling me is that I'm not going to buy or sell a home because of this pending crash. Well, guess what? We're going to talk about that, so you're going to learn the truth. People are not taking action because they have a fear, and people have fear because they simply don't know the truth. So guess what? Our local real estate market isn't going to crash, and that's what we're going to discuss here in this quick video. So I want you to pay close attention to what we're going to be talking about, and there's many factors that we're going to discuss that show that this crash just simply isn't going to happen. I've read and reviewed many articles by top real estate professionals to explain what's going to happen on these upcoming few months and maybe possible years. I've been a real estate agent now for over 18 years, and I always find it interesting that people believe family, friends, and other resources over the experts, such as myself or others. Now, I don't know why that's the case, but I hope that you'll stop doing that and go to the expert. If you're somebody who needs help with a physical issue, do you go to a carpenter or you go to a doctor, right? So that's what's going to apply here. So many of these non-experts are using the numbers from our last crash that took back in approximately 2008. And we're going to talk about that year versus this year and explain to you more about the marketing conditions. So let's take a look at the facts. Okay, so here's some data I put together to show the differences between 2008 and 2023. So the first slide here is inventory levels. And in 2008, we had an abundance of new construction. That came from builders who were building spec homes, and the banks were lending based upon that. But what happened, they overextended themselves too, because they had just continued to do this over the years, and we hadn't seen the issues that were going to come at that time to the lenders. Plus, we also had existing homes on the market, and then the introduction of foreclosures and short sales along with bank-owned properties all contributed to the abundance of homes on the market at that time. But in 2023, we have just the opposite. For the last 2 or 3 years, we've seen a housing shortage, as you know, because with that, buyers have been acting out of the norm and doing what I call panic purchases. They were buying homes way above values, which ultimately has kind of caught up to the market now. Plus, we had the inflated prices issues through these purchases. But another big factor is that we had low mortgage interest rates. But now we know that that's changed. But all of these contributing factors caused a shortage within the market, which we're still experiencing right now. Now let's take a look at the mortgage industry. And in 2008, the lenders at that time and previously had what is called stated income loans. Now these loans were very unusual because they did not require any W-2s, tax returns, pay stubs, or financial records. Basically, a borrower could go in a lending institution, tell them that they had a job more or less and looking to get a loan, and they would give it to them. Based upon those premises. And credit scores didn't even have a significant impact on it as well. So this set up a bad lending scenario at that time. Then after that time period, the government came out with federal regulations. So we currently have those regulations in place, and they do require that a borrower needs to file tax returns for the last 2 years, or they can have W-2 statements. But there is also, the banks require a 2-month statements to show that they have money in their accounts and pay stubs from a current employer for 2 pay periods. Plus, credit scores need to be at least 620. And now there's another factor that contributes to this. It's called the debt to income ratio, so that borrowers cannot overextend themselves like they have done in the past. The next slide's going to talk about is the illegal activities that we seen back in 2008. We had collusions with builders, lenders, appraisers, realtors, and investors. And what they do is that they would inflate prices, they'd draft up contracts that would help the parties in these transactions to get money back from the sellers, and that some of these people would take those funds and never make a payment and walk away. And so this also contributed to that time period of illegal activities, and people were pocketing those seller credits. But what we have now in place is more, once again, legislation which protects against those kind of activities, that the government came in and set up what are called third-party appraisal companies, which prevent lenders and buyers and title companies to talk with appraisers, so that there's no collusion there anymore. So they have also stricter appraisal guidelines that they must follow, and there's no more gifting allowed, which closed up that loophole as well. Here's another factor too to consider, that mortgage rates back in 2008 were pretty close to where they're at now. However, we experienced a much broader range between 6 and 7%. So that has a big influx, where back in 2008, we didn't see those kind of activities. Now let's look at something very interesting as well, and that's the annual median family income. Back in 2008, it shows that people were making roughly, each family income, close to $57,000. As compared to 2023, now it's up to $79,000. So a percent increase of roughly 27% from the different years of 2008 to 2023. Now the next thing we want to go over is the debt to income ratios and how that affects this. So 2008, the debt to income ratios was roughly, like I said before, it didn't apply it, but it was roughly about 52% and sometimes higher. So that would allow somebody to get a loan for $2,500 a month in payments. But in 2023, the DTI maximum now is 45%, which comes out to close to $3,000 a month. So a percent increase of roughly 16% exists between those two time periods. Now, as I talked about also earlier, is the median home prices. In 2008, the average median home price was $180,000. Hard to believe it's that low. Now it's up to nearly $509,000, which is an increase of almost 79% in that period of time. So those home prices have certainly soared over the years. Then if you take the median purchasing power between the 2 years, in 2008, you look at the interest rate, the income, the debt to income ratio, which equals nearly $350,000, as compared to 2023, which is $481,000. Now you'll notice I have some numbers after that. The 1.94% means that somebody's ability to purchase a home, or how many homes, could be almost 2 home purchases, where in 2023 it's not even 1. We're not even at 1%. So you can see the impact that prices, interest rates, and debt to income have had on the market, which makes it far more challenging for buyers to purchase the home. So mostly up to this point, I've used my data to show why the Utah housing market's not going to crash. Okay, now let's look at what the professionals are saying about our Utah market. And these articles come from national publications as well as local. The first report is by USNEWS, and this article has a statistical-based report on Utah as being ranked the #1 state in the country to live in, which is a very good thing. However, it also drives up the desirability to move here, which means that housing prices will stay high. And it also makes it that people are looking to move here because of our economic and profitable institution, which we are, according to US News. The next article also comes from US News, and it's talking about the economy, fiscal stability, push Utah to the top in best state rankings. And just part of the excerpt here, says, I think Utah has one of the strongest economics in the country, and it has for some years, says Phil Dean, the Chief Economics and Public Finance Senior Research Fellow at the University of Utah, okay? And they get a quote from him. Now, our next graph I want to show you is from the federal government, and this is a trend analysis that they publish, and you can see, if you go back to the 2008 mark, where we are now, there has basically been a steady growth curve, and it has accelerated over the last 3 or 4 years, as we know, like the rest of the markets have around the nation. You can see that this graph does not indicate any kind of decline in the demand for housing. So that's something to consider. Our next report here is from the Utah State Realtors Association. And this graph is showing what our trends are looking like. The blue line is showing the demand for homes, and the red graph is showing the number of homes on the market. So you can see there's a deficiency there, and has been trending that way, and it's going to continue to do so based upon their analysis. This next report is also from the utahsrealestate.com, and if you look, there's a bunch of numbers, but what I want you to focus on is the pie graph, or circle, that 43% and 5% added together is nearly 50% of all homes sold are under 500,000, which is similar to what I stated in my data, that's where most of our sales are coming from. But the irony or the challenge is that there are few homes to even choose from. Therefore, it creates a significant challenge. The next article talks about is the housing market forecast. Will home prices drop in 2023? This article comes from Money magazine, and it says the second half of the year is shaping up to be fairly boring, with very little prospects of sales shifting up or down through the rest of the year. Well, that means we're a steady market. They don't see any kind of indication that's going to cause changes to the market. So Greg McBride, one of the from Bankrate, also says similar data in that prices will remain fairly steady, and in a lot of markets, that's a price that is 40% or more higher than pre-pandemic prices. So even though the pandemic drove up prices, and along with the shortage in interest rates, he says it's going to continue to stay strong. Okay, so that's something to show that he also feels the same way. Now, our next graph here and information is from Dave Ramsey. I know that most people are probably familiar with Dave, but he also has the same feeling and thought as the rest of these other experts. And in his analysis, he said, when will the housing market crash? Well, based upon the data, it's unlikely that the housing market will crash in the next few years, because the current market is so different from the housing market crisis that caused the Great Recession from 2007 to 2009. So Dave doesn't feel like it's going to affect that. And then our final one here is from another great and well-known publication. It's Forbes, and it says the best mortgage refinance lenders of September 23. It says, will the housing crisis crash in 2023? Home prices overall remained resilient between April and June, even as mortgage rates crept higher, according to the latest Standard & Poor's. So even though the rates have gone up, the demand has continued to gone up as well. So there is nothing in these articles, nothing that I've seen that has indicated that we're going to have any kind of crash. Well, there you go. I've told you why the real estate market isn't going to crash. So have 5 other experts that we've just talked about. Do you believe me now? As the buyer, your best strategy, in my opinion, is to help you save thousands of dollars on what the market could possibly go back up again, is to buy now. Why? Because if the rates go down, home prices are going to take off again, and it's going to make it even more challenging from you as a buyer to be able to purchase a home. So why not buy now? And we can help you get your points down by about 2%, and some other techniques which we have that we use with all of our other buyers to help you. So if the market does take off, guess what? You're now locked in at a lower purchase price, and we'll help you refinance for long term to keep those rates low. So you get the best of both worlds. So I hope you've enjoyed this video, learned a lot, and share it with others so they can learn the truth like you now have. Thanks, and hope to see you on my next educational video. Thanks very much.